Tesla just raised the price of its Cybertruck dual-motor all-wheel drive from $59,990 to $69,990. That change became effective March 1, 2026. At the same time, the company removed the lease option for that trim. Separately, Tesla says its supervised full self-driving fleet has now logged about 8.4 billion cumulative miles. Start with the price move. 2 weeks ago, between February 18th and 20, Tesla rolled out the $59,990 entry price for the Dual-Motor AWD version. Orders surged, delivery estimates slipped. By February 28th, Tesla's website indicated that the $59,990 price applied only to orders placed by that date. Then, as of March 1st, the price jumped $10,000, about a 17% increase. Financially, what changed is simple. For every AWD Cybertruck delivered at $69,990 instead of $59,990, Tesla collects $10,000 more in revenue. Revenue is just total sales dollars. If costs don't rise at the same time, that extra $10,000 mostly drops into gross margin, which is basically how much profit they keep per vehicle before overhead. But here's where it gets interesting. We do not know how many trucks will actually sell at the new price. Tesla has not disclosed how many orders were locked in at $59,990 versus how many will convert at $69,990. There's no public figure for firm, non-refundable orders at the higher price, so any estimate of incremental quarterly revenue is projection, not confirmed data. If, hypothetically, thousands of units deliver at the higher price, quarterly revenue rises accordingly. If cancellation rates spike after the increase, some of that uplift disappears. That is the balancing act. Now add the lease removal. Leasing spreads payments over time. It can lower monthly cost and widen the buyer pool. Removing the lease option could reduce total unit demand at the margin, but it also shifts buyers toward full upfront purchase. That improves working capital, the cash Tesla has on hand to run the business, because more money comes in immediately instead of over years. Are delivery delays tied to demand or production limits? Reporting notes that some configurations now show delivery windows stretching into 2027. Tesla has not publicly broken down whether that is pure demand strength, production constraints, or a mix. Both interpretations are possible. Now, zoom out for a second. Cybertruck is still a fraction of Tesla's total deliveries. Tesla has not disclosed what percentage of overall deliveries the AWD Cybertruck represents. So even a $10,000 increase per unit does not automatically reshape company-wide earnings. The magnitude depends on volume. Has Tesla disclosed production cost per Cybertruck? No, so margins at the new price are assumed, not confirmed. We can say higher price improves potential gross margin per truck. We cannot say what the final margin is. Did the stock move meaningfully on this? In the latest snapshot, shares were around $402.51, down about 2.9% in that session. There was no major one-day shock clearly tied solely to the pricing change. There were also no widely published analyst estimate revisions within the 24-hour window specifically recalculating EPS, earnings per share, which is profit divided by shares outstanding, because of this move. Was $59,990 temporary? The timeline suggests it may have been positioned as a limited window. By February 28th, the configurator indicated the lower price applied only to orders placed before that date. Some investors likely assumed elasticity testing, meaning Tesla was probing how sensitive demand is to price. Now bring in autonomy. Tesla says its supervised full self-driving fleet has logged roughly 8.4 billion cumulative miles. That number comes from Tesla Materials and reporting. It is not independently audited in the way financial statements are audited. It includes cumulative miles over time, not just recent miles. The company has not broken out how many of those miles were logged in the most recent quarter versus earlier years. Does 8.4 billion miles mean regulatory approval is imminent? No, mileage accumulation does not equal regulatory clearance. Agencies like the National Highway Traffic Safety Administration monitor driver assist systems, and no new regulatory action was announced in the past 24 hours tied to this milestone. But it does strengthen Tesla's data lead argument. More miles mean more real-world driving data. In theory, that can improve software performance. If that software eventually becomes a fully approved autonomous product, the revenue opportunity could be large. That is a long-term scenario, not a confirmed near-term revenue stream. So, is this already priced into the stock? Hard to say. Tesla's valuation multiple, how much investors are willing to pay for each dollar of earnings, already reflects expectations around autonomy and software. Many investors assume future monetization of SSD subscriptions or robotaxi concepts. This milestone reinforces that narrative, but does not instantly change cash flow. Does the $10,000 hike expand margins enough to move EPS in 2026? Only if volumes hold and cancellations remain contained. If higher pricing offsets lower volume, earnings could improve modestly per unit, but flatten in aggregate. If demand weakens, the gain shrinks. Who benefits? Early buyers who locked in $59,990 could see resale support since MSRP is now higher. Tesla benefits from stronger per-unit economics if orders stick. ETF holders are indirectly exposed because Tesla is a top holding in tech-heavy funds like those tracking the Nasdaq 100. That means any volatility here can ripple into retirement accounts. Short sellers, investors betting against the stock, could face pressure if margin expansion proves stronger than expected. But what could go wrong? Cancellation rates could rise after the $10,000 jump. Long delivery timelines into 2027 could deter new buyers. Macro conditions, interest rates, consumer confidence could weaken appetite for high-ticket vehicles. Regulators could intensify scrutiny of driver assist disclosures. Competitors like Ford, GM, or Rivian could respond with aggressive incentives. None of that happened in the past 24 hours, but those are real variables. Does this confirm Cybertruck profitability? No. Does it eliminate competitive risk in electric trucks? No. Does 8.4 billion miles guarantee monetization? No. Here's what to watch next. Any data on cancellation rates, delivery timeline changes, whether Tesla discloses Cybertruck gross margin separately in future earnings calls, whether analysts revise EPS estimates in the coming weeks, whether FSD subscription revenue trends upward, whether regulators issue new commentary on driver assist systems. What would turn this clearly bullish? Strong delivery volume at $69,990 with minimal cancellations and margin disclosure showing healthy profitability. What would turn it bearish? A visible order drop-off, rising refunds, or regulatory setbacks that delay autonomy monetization. Right now, what we have is a $10,000 price lever pulled upward and an 8.4 billion mile milestone highlighted at the same time. One affects short-term per-unit economics, the other feeds a long-term software narrative. Whether those two threads converge into higher sustained earnings or collide with demand limits is the part investors will be watching unfold next.